super pumped because today we're talking to my longtime friend, Michael Oziel. Thanks for being here.
My pleasure.
He is a mortgage broker with the Millennial Financial Group. So I'm super excited that you're going to give us some of your insights with working with millennials too. So it'll be great.
I very much look forward to it.
It's going to be fun. Okay, so let's talk about this. Mortgage brokers. Are they the first people we should be talking to when we're first getting started? Like, we all are like excited about our realtors. Maybe you're a bit more of the undercover, but when should we really be working with our mortgage brokers?
It's a great question. Most of the time, people will go to their realtors before going to the mortgage broker. But what good is it to meet with a real estate agent before you know how much you qualify for? Your best bet would be speak to a mortgage broker first, determine how much you pre-qualify for, then you go meet with your real estate agent and you can go shopping.
So that's kind of like your license to go shopping,
Exactly right. I grant the license.
There you go. I like that. So let's say, for example, that I am thinking of buying a house. When it's just like a twinkle in my mind, should I come talk to you? Should I try to save on my own and fix my credit by myself? Or sort of, if I'm not ready to buy right today, is it still worth talking to you? Are you going to feel like I'm wasting your time?
Absolutely not. The best place to start is a conversation with me. And that conversation could be as easy as over email or by phone, or if it's more comfortable for you, we can meet in person. If there's credit issues, I can give you a little bit of counseling on how to fix the credit. If you have questions as to how much down payment's required, I can give you an idea of what you need. If you want your mortgage payment to be a certain number, I'm going to tell you how much mortgage you're able to borrow to make sure that it meets your monthly budget.
Okay, so basically, if I know I want to buy in a year or two, you don't mind if I give you a call. All right.
Come and see me.
Awesome. And what I like about that is that, your mortgage broker, and Michael specifically, can help you what, like, do's and don'ts, because we didn't learn about credit in school. I don't know, did you learn about managing your credit?
I didn't learn about any of that in school, unfortunately. Maybe it should be part of the curriculum, but with that being said...
We'll work on that. So what I really like about what you said is that you're going to help them fix their credit, so that they're, if it's not quite where it needs to be. I know things like if you don't pay your cell phone bill, you can damage your credit. So you're willing to help along the process to make sure they get in tip-top mortgage shape, right?
Absolutely. So if there's any credit concerns that you've had over the last few years, and that could be as little as you may have forgot to pay your hydro bill in university, or it could be, like Limor mentioned, it can be a cell phone bill that you paid late a few months.
Sometimes on purpose, right? If you're like mad at your phone provider, people don't realize that it's going to damage them in the long run.
Yeah, that's for sure, that's for sure. But that's something that I can absolutely help out with. And I'll give you an idea of, number one, what's the issue? Number two, how do you fix it? And number three, how long is it going to take before you can actually go to buy a property that your credit's going to be repaired?
I like that. Just kind of helping understand what that time horizon is going to look like, which is great. Okay, so let's say that I'm not, 2 years away, and I come to you. What's going to happen next? Like, what do you actually even do?
So I call it the 3 criteria of getting a mortgage pre-approval. Number one is you got to know what your credit score and what your credit history looks like. Number 2 is how much down payment do you have? You need to know a figure in your head as to how much you have available for the down payment on that first property. And number 3 is what do you do for a living and how much do you earn, which is the biggest determinant as to the bank saying how much can you afford to pay us back and how long is it going to take for you to make those payments to us.
So are all 3 of those, so there's the credit score, credit history, there is how much money you have for a down payment, and your employment or your income scenario.
Exactly right.
Now, do they all 3 equally fit together?
It's a combination. It's a great question, Limor. It's a combination of all 3 of those. The bank is, just because somebody's making a lot of money and has a big down payment but has maybe a poor credit history, the bank's not just going to come along and say, no problem, we're going to give you the money. It's a combination of all 3.
Right.
But a lot of weight is put on making sure that the individual is able to make the payments.
Right. So while they're all 3 important, I'm assuming that, like, if maybe one's not as strong, you could maybe kind of compensate with the other? I don't know, I'm making that up. Is that true? Like, let's say
to a certain degree.
Okay. So if I have like just terrible credit, it doesn't matter if I have like 80% down.
Correct.
All right. So that makes a lot of sense.
Yes, there are other routes, but for the purposes of this conversation, I think it's best to just say
all three are important.
All three are important, and it's a combination of all three of the criteria coming together and meshing well together, and the bank saying, overall, we want to lend money to Limor.
Right. Okay. So if I've come to you, you're going to introduce these three concepts to me. I'm assuming we're going to have a pretty detailed conversation about all three of those elements, and then what? Let's say, Michael, I want to go shopping. What do you need to do in order to give me that license to shop, which we were chatting about?
So again, going back to the three criteria, you have to go through all the criteria. From there, I'm going to say to you, you are able to purchase a property of, let's just say, for example, $500,000 based on your down payment. For example, let's say $100,000 being 20% down.
Right.
You have a $400,000 mortgage. You're then going to receive a pre-approval letter from me or the bank. And
now, in order for you to give me that pre-approval letter, I need to give you like all the paperwork under the sun, right? It's not just like, is it me saying like, oh yeah, I make $100,000, or do you actually need all of my pay stubs, like all of my account numbers and everything? Like, how solid is this?
It's always best to provide more than less up front. So you should be prepared to provide a pay stub, an employment letter from your employer, a copy of your bank statement showing that you have the down payment. If, for example, maybe some of the funds are going to be gifted from a family member, you should ensure that the gift is ready to go and that it's definitely in place. And for the time being, that's going to be more than enough to get you into the world of shopping for real estate.
Okay, and so I've heard pre-qualification and I've heard pre-approval. So let me know if this is kind of what I've made of that. So pre-qualification is like me, I just go onto a website, I like plug in a bunch of numbers, maybe I did it right, maybe I didn't, it spits that number, I'm like, okay, I'm pre-qualified in theory, and then once I come to you and I give you all the paperwork, then I'm going to be actually properly pre-approved.
Pre-approved. That is absolutely correct.
Okay, cool. Love it when I'm finished with this. Okay, so then when I am pre-approved, are you giving me a mortgage lender? Are you giving me a rate? Or are you just saying, go for it and play in the marketplace? Like, what does it include?
So the pre-approval is going to entail a letter from the bank that tells you exactly how much mortgage you're pre-qualified for, along with an interest rate that you're locked in for anywhere between 90 to 120 days.
Okay. So that means that if inside 90 to 120 days I put in an offer or I close on a property, or what does it mean?
It means that the rate is locked in under your name. You've secured that rate without buying a piece of real estate for 3 to 4 months.
Okay, so the pre-approval letter, it's all fancy. It says I have 90 to 120 days. What do I need to do in that 90 to 120 days in order to lock that rate? Do I need to put in an offer, close? Like, what does that mean?
Limor, you've got to find a property. You've got to close within 120 days. So you better go shopping right away.
Sweet.
And make sure that you keep in touch with me or your financial institution to ensure that the pre-approval is continuously locked in after your previous one is expired.
So actually you can renew it?
You can absolutely renew your pre-approval.
At the exact same rate?
No.
No, a brand new
Unfortunately,
rate.
you're going to be subject to the rates at the time that you're looking to renew the pre-approval.
Okay, and I asked this specifically because we had a bit of a rate hike in July. So this may be a bit of a technical question, but if I had a pre-approval that was expiring, let's say 2 weeks after the rate hike, and I knew the rate hike was coming, could I come to you and say, let's lock in again just before the rate hike to give me another 90 to 120 days?
Yes, you could. So that is the beauty of working with somebody who's in your court like a mortgage broker. I'm going to make sure that I'm contacting you prior to the rates going up to ensure that you lock in that best rate. And before the Bank of Canada increases rates, you're going to get locked in at the best rate you possibly can.
Yeah, I knew you'd be on that.
Absolutely.
So okay, so we've got this in. So basically it's a license to then go shopping. Does that mean that I need to be in touch with you for any reason before I put in an offer? Can I just offer away and know that like I don't necessarily need a financing clause because I'm approved. Like, what's the ideal way for a first-time home buyer kind of in this part of the process to kind of keep you in the loop and make sure that they stay away from any accidental traps?
Step 1, get a pre-approval.
Okay.
Step 2, before you make any offers on a property that you like, make sure that you contact me. Make sure
so before I put in the offer?
Before you make that offer. Because you know what? For example, if you're purchasing a property that's on well and septic versus being on municipal water, that might pose a bit of an issue. So you want to make sure that you're constantly in contact with your mortgage broker or your bank to ensure that the property meets the qualifications that the pre-approval fell under.
Right, so the pre-approval actually pre-approves me,
right,
but it doesn't necessarily pre-approve every property in the world that I may want to buy. Is that how it works?
Right. That's exactly right.
Okay, so it does make sense before I put in an offer to reach out to you. Another one I know you and I have talked about is if the condo fees are really high, that could potentially impact the approval.
Of course. So unfortunately, condo fees and property taxes are the two variables when purchasing a property. The condo fees on an older property are more than likely to be a little bit higher than the condo fees on a newer property.
Yeah.
So if in the initial discussion with me, I would have asked you, are you looking for a newer condo or an older condo? If your decision changes from you originally would like a newer condo and now you'd like to go with an older condo, likely the condo fees are going to be higher and you're going to be qualified for slightly less than you would have on the newer condo.
And I think that happens all the time because I'm like, of course I want a new condo. Of course I want like full amenities.
Yeah.
And then I go out in the marketplace and I'm like, oh, this is what I can't afford. So in reality, sometimes a little bit more outdated condo buildings can have higher fees, so it actually can impact.
Right, and that's why I would always say that best practice is to ensure that you speak to your mortgage broker before making the offer on the property, just to make sure that the property qualifies and that everything in the mixture that I was mentioning earlier blends together nicely so that you have a seamless transaction.
Yeah, okay, no, I like that. I think it makes a lot of sense. And, I think a lot of times it's like, oh yeah, I'll get back to the mortgage broker once I have an approved offer, and then you end up in a tough situation. So I actually just want to backtrack for a minute. So we started, with the 3 elements that we're going to talk to you about. Let's talk a little bit about the down payment and how much you actually need and what happens when you don't have 20%.
Wonderful. So,
because it's tough to save 20%.
It is
Let's
very
be
tough.
honest here,
We
right?
all know that the prices of real estate have skyrocketed, and it's not always easy to save up that 20% like Mrs. Fabulous has just mentioned.
I like that.
Conventional financing versus high ratio financing. There's 2 different types of mortgages. Conventional means that you're putting down 20% or more on the purchase. For example, if you buy it for $500,000, 20% of $500,000 is $100,000 for a down payment. Not always easy to save up $100,000.
Not if you want to live downtown and like go to restaurants and have vacations and good quality of life. Okay, so 20% would be a conventional mortgage.
20% is a conventional mortgage.
Okay.
But let's say, for example, you're not able to save up that $100,000 just because it's very tough to save up that kind of money. The government has in place a program called high ratio financing, high ratio mortgages, which basically means that you're able to put down less than 20% on a purchase. So the government today, so long as you're purchasing a property less than $500,000, you're able to put down as little as 5%.
Of the purchase price.
Of the purchase price. So going back to my example, let's just say you want to buy a condo that's worth $500,000. You can put down as little as $25,000 on that condo, and you can get a mortgage for the remainder of the purchase price.
If I understand this scenario correctly, I need $25,000, which would be 5% if I'm buying a property that's $500,000, which is the minimum I would need in down payment. But I do believe that there's some additional fees called default insurance that I need to pay on that. How does that work?
So the default insurance is basically a premium that the government charges for the mortgage insurance, which allows you to get into the market with less than 20% down. And that is a fee that the government charges that is added to your mortgage. There's a very large misconception out there that an individual or a buyer needs to write a check for this government fee and write it right on the spot, when that's not the case. It's truly that it gets added to your mortgage. So let's use real numbers for an example, because I always find it's easiest.
Totally. Okay, so we said we were going to buy a property of $500,000. Is that cool?
Correct.
And I'm going to put $25,000 down.
Perfect.
Okay.
So that means you need a mortgage of $475,000.
I could do that in my head. Okay.
Now, for example, the government charges a fee of $10,000.
Okay.
That $10,000 fee is added to the mortgage. So that $475,000 mortgage is now going to be increased to $485,000.
So hold on, even though I'm going to put $25,000 down as my deposit, or as my down payment, sorry, and I need a mortgage of $475,000, the additional $10,000 in fee gets added to my mortgage, so my mortgage is $485,000.
Right.
Oh,
and then
that's interesting.
And that $10,000 ends up getting paid off over a 25-year amortization, so you really don't feel it that much.
So I'm paying interest on that as well, too.
You are paying interest on it.
But at the end of the day, like, and this is what I love about how you talk about this, it's like, okay, are you going to get in the market, or are you going to get in the market? Like, you could save for another 25 years to get to your $100,000, but if you just want to get in, like,
it gets you in. The most important thing is getting into the market and making sure that you feel financially fabulous about your purchase.
Yeah, I love it. It sounds so great when you say it, right? Okay, and so in doing so, I've got the 5% down plus the CMHC, and I really like how you explain that, because I think most of the time, you know, you're like, I put in $25,000 down, shouldn't I have $25,000 of equity? But it doesn't necessarily translate that.
It doesn't. So yes, you would have put down $25,000 on that $500,000 condo, but in essence and in reality, you only have $15,000 of equity in the condo because of that $10,000 fee that the government's charging to get into the market.
Right.
But it's not that bad when you look at it as, what's the alternative?
Right. What's the alternative, for sure?
You're in the market.
Now, in our example here, we're just kind of doing simple math. It's not necessarily the amount it would be, and there's still closing costs and all those kinds of things for us to talk about. So when you are working with a first-time home buyer, are you the person who explains to them what all of those fees are and explains to them kind of all the math of how it's going to work, or is that sort of the lawyer's job at the end, or do you guys work together, or I don't know, how do you guys do it?
That's a great question, and I would say that closing costs are one of the largest miscalculations that first-time buyers have.
Okay, tell us why.
Okay, so the closing fees on a property are going to be legal fees and disbursements, which is whatever your lawyer charges you for their fee to close the transaction.
Right.
Number two, you're going to have land transfer tax that you're going to have to pay.
Yeah. We do know some parts of the country are different from land transfer.
Yes, we do.
So I think, go ahead.
Sorry, I apologize. Your respective lawyer will definitely be able to give you the exact number as to how much land transfer tax will cost you. And if you're a first-time buyer in many of the provinces, you're able to benefit from a first-time buyer rebate.
Correct.
Which is going to reduce that bill and make it a little bit easier for you to get into the market, and a little bit of a buffer for you to be able to get in. Yes.
So for now, let's say that the land transfer piece is one our lawyer is going to fill us in. It's different provinces. There's some rebates. There's all kinds of stuff, but our lawyers will help us with that piece.
Correct.
But other than that, what are the other costs associated with closing? And then when you're working with a first-time home buyer, are you explaining to them all those costs like right up front?
So the way that I work is I do explain some of the costs. I will always refer to their lawyer to get the exact land transfer tax.
Yeah.
But what are the costs that you should expect are legal fees. You may have an appraisal cost that you need to pay, which is going to be maybe $250, $300, somewhere in that range.
It does depend. For some reason, I've done some out in Saskatchewan, and they've been as high as like $700.
It has been.
So I don't know if
it depends, yeah.
Yeah, I don't know if it's like lack of appraisers or what it is, but I guess it can range maybe a little bit more than that. But typically, I think bigger cities are a little cheaper.
Yeah, I guess, depending on where you are in the country, of course. But other than that, really legal fees, your legal fees, your land transfer tax, and your appraisal costs are really going to be the only fees that you're going to incur as a first-time buyer.
Right, because the CMHC insurance is going to be baked into your mortgage overall.
Correct.
Okay. So then why do you think that it's one of the numbers that people miscalculate or misunderstand the most? Is it when they're trying to do it by themselves in their head, or what they saw off the internet and try to make it up? Is that why?
The internet is the worst mortgage calculator. Unfortunately, and
there's so many too.
I know, and unfortunately, the internet calculator never seems to calculate the exact right number.
Yeah.
Again, if you're looking for a great mortgage calculator that is going to give you the right number,
it's sitting right here.
just pick up the phone and you can and you can get the number, or shoot a quick email and you can get the exact number as to what it's going to cost you. Because most of the time, the calculators online do not take into account the CMHC fee. Again, this is if you're not putting down, if you're not putting down less, if you're not putting down 20%, the online calculators are not going to add in that CMHC fee that is going to increase your payment ever so slightly.
Right, right. Okay, so we're going to come and talk to a professional to try to help us out so that we know what we're doing.
It's always best
always
practice.
favorable. I agree. Okay. Now, we know that the price of real estate is super expensive. I mean, even if you're a millennial in Montreal or in Calgary, where like the prices are a little bit lower, it's still like pretty expensive. So, I mean, I've seen a lot of millennials getting some financial help from their families, as well as some help in qualifying with the mortgage. Now, I believe there's two ways that a family member can help qualify for a mortgage. I believe one's more popular than the other, or the banks are getting more money. Can you maybe just explain to us
Sure.
like a little bit like how does that work if like my dad needs to get in on helping me qualify for the mortgage? He's not going to live in it. I'm going to live in it, but he's helping me out.
So the two ways that a family member could help you out with qualifying for a mortgage is, number one, they can help you with the down payment. So they may be able to increase your down payment a little bit more than what you have.
Right. Would they still be on the mortgage in that instance?
In that instance, they would not be on the mortgage.
Okay.
So that would simply be
just money. It's a present.
A gift.
A gift.
So the banks call it a gift to the borrower, to the buyer of the property, and you will use that money towards the down payment on your purchase.
Okay.
Number two is a cosigner.
Right.
So of course, you are allowed to have, really any family member can co-sign for you, or any friend can co-sign for you. It will help the mortgage application if you're looking to qualify for a little bit more than what you qualify for on your own.
And so then they would be a co-borrower in that instance.
They would be a co-borrower in that instance.
And do the banks still allow something called a guarantor, or have they totally moved away from that? I've heard about it, but I've heard it's like doesn't really happen so much.
Yeah, so I'm constantly asked, what's the difference between a guarantor and a co-signer or a co-borrower?
Yeah.
A guarantor is on the mortgage, but not on the title of the property.
Correct.
A co-borrower or a co-signer is on the mortgage and on the title of the property. It's very rare these days that the bank will allow a guarantor to be on the mortgage and not on the title. So yeah, it's very popular now that the banks are asking for co-signers or co-borrowers.
I mean, at the end of the day, like from our perspective, like whether my dad was a co-borrower or a guarantor, like he'd be on the hook if I don't make the payments,
Exactly
right?
right?
So it's just a bit of jargon.
Yeah.
More than that. Okay. So then you would need the co-borrowers, all of their information as well.
Yes.
And so even if they make a lot of money, if they've got their own mortgage and debt, you got to take that into consideration too.
Yep. Unfortunately, that is the case of a mortgage application.
Yeah, that's super interesting. Okay, so then if we continue to sort of move through the process, when I've been pre-approved and let's say I'm putting in some offers, at that point in time, is that when you're going to say to me, oh, do you want a fixed or a variable or all the other nuances associated with the mortgage? Like, is that when you would start to introduce all those factors to me?
I would probably introduce that at an earlier time with you.
Okay.
Because I would want to ensure that you understand what the difference between a fixed and a variable is.
Can you maybe explain to us now?
Absolutely.
Sure.
A fixed rate mortgage is very simple. You lock in at one interest rate for the term of the mortgage. So for example, if you take a 5-year term, and let's just use, for example, 3% is the fixed interest rate, you are guaranteed for the next 5 years to have a 3% interest rate on your mortgage.
So every single payment is going to be the exact same?
Every payment is the exact same. There's no fluctuations.
Okay.
Number two is variable. Variable is a fluctuating interest rate and will fluctuate with the bank's prime rates.
Okay.
So We recently saw an increase in prime rates.
Yep.
So we recently saw an increase from 2.7
Okay.
prime rate to 2.95 prime.
Okay.
That increase in the interest rate is a 0.25% difference. So if you were on a variable interest rate, your interest rate would have fluctuated up by 0.25%. In the same manner, the interest rate can go the other way.
Are there any other reasons why you may want to have a variable mortgage? Like, I don't know, to me right now, based on the things you've explained, I'm not sure that there's a lot of benefits to it.
It would really depend on what your intentions are with the property. Okay. So if, for example, you were to come to me and say, Michael, I'm looking for a short term, I'm not totally sure what I'm going to be doing with the property in the next few years, it may make more sense to go with a variable. Okay. Why?
Okay, why would I want to do that?
The penalty to break the mortgage. So everybody hears these horror stories about the banks charging these astronomical penalties that you need to pay to get out of the mortgage. On a variable rate mortgage, the penalty is always 3 months interest only.
Okay.
Which is a good thing.
That sounds much.
It's going to keep that penalty very low.
Right.
On a fixed rate mortgage, it's called 3 months interest only or interest rate differential, which in plain English basically means how much interest you owe on the mortgage for the remainder of the mortgage. And it's the whichever is greater of the two.
Yes, I have broken one mortgage before, and it was a fix, and it was a nightmare.
I'm sure it was.
I paid a lot of money, so yeah, definitely.
So again, part of the preliminary discussion that I'm going to have with the first-time buyer is I'm going to ask them, what's your intentions with the property? What do you see happening over the next 5 years with this property? And based on the feedback, I'm going to advise correctly as to what type of mortgage, and that may not always mean take a variable. It might mean take a shorter term mortgage.
Yeah.
Maybe take a 3-year term instead of a 5-year term. Maybe take a line of credit instead of taking a mortgage. There's a lot of different
creative ways you could do this, right? So that's why I think it makes so much sense to be chatting with you up front with what we're looking to do. So while we're on the topic of like types of mortgages, I think that maybe a bit of the misconception is like the lowest interest rate I could possibly get is going to be the best mortgage that I can get. Do you agree with that, or what other things should we be looking for in a mortgage?
Interest rate is not always the most important piece of information. It's not always the most important part of the mortgage.
Yeah. What else do we need to look at?
You need to make sure you're looking at the prepayment privileges.
Okay.
So what are those? That's the ability to pay down your mortgage at any time that you want.
So, okay, let's just back up here.
Okay.
If I'm borrowing, like my previous example, $485,000, if I like win the lottery, can't I just like pay the bank back the whole thing on a mortgage? Like that would be my, or I think most of our typical understanding. It's like, okay, I got the money. If I want to give it back, can you not always even give it back?
Unfortunately not. The banks are going to charge you a small penalty to get out of the mortgage and pay it off early.
Or a large one.
Or a large one if you're on a
if
you're on a fix for 5 years.
Yeah.
But again, that's part of the initial conversation I'm going to have with you, is because if you're receiving bonuses at work.
Right, but I won't know if I'm going to win the lottery.
Yeah, you don't know when you win the lottery, but let's just go with chances
All right,
are
let's just
that
say
you
I
may
get
not.
okay, let's just say I get a bonus at work.
Okay, so this is more of a realistic
Okay.
and a more common example. You want to make sure that if you get a bonus at work, that you're able to use that money and put it down towards your mortgage. There are lenders out there and there's products out there that won't allow you to take your money and put it down towards a mortgage. So for example, going back to Limor's $485,000 mortgage, if you got a $15,000 bonus at work and you wanted to use that $15,000 and go pay down your mortgage to $470,000, you want to make sure that you have that feature on your mortgage. Number two is, what if you start earning more at work and your bi-weekly pay and your bi-weekly salary goes up by a few $100s? You want to be able to increase your regular mortgage payment by that few $100s so that you can pay down the mortgage faster. part of the mortgages out there, part of the most important features on a mortgage out there is ensuring that you have a prepayment privilege available to you.
Okay. And are there other facets or elements to the mortgage we should be looking to as well, other than the interest rates on that?
So interest rate, prepayment privileges, penalties to break. You want to ensure that you're getting a standard penalty to break. So again, going back to the previous example, on a fixed rate mortgage, the penalty should be 3 months interest only or interest rate differential, whichever is greater. On a variable, it should be 3 months interest only at all times.
Now, wasn't there one bank out there that if you needed to break the mortgage, you either had an insane penalty, like if you wanted to break it to go to another bank, you couldn't or something? Don't mention the name if you don't talk about.
Absolutely, I know exactly where you're going with it. There are banks.
They might be the only one, right?
No, absolutely. There's banks that may offer you a slightly lower interest rate. Just make sure you read the fine print. And most of the time, you don't want to be restricted. When you're borrowing that kind of money, you don't want to be restricted to different limitations and rules that the banks put in place for you. You need flexibility.
Right.
You're borrowing $485,000. The last thing that you need is to be tied into that mortgage and not have the ability to customize it around your finances.
Right, that makes sense. And then now one of the features that I know some of the mortgages have is being able to port them. So if you need to move, upgrade, downgrade, whatever you can, how does that work?
That's another huge feature of a mortgage that you have to make sure that you make that the mortgage entails. You are able to port the mortgage from one property to another. So let's just say, for example, you outgrow that $500,000 condo that you bought 2 years ago.
Had a great condo, but like, you know, married with kids, like we don't all fit in that little.
Next thing you know, you need
right.
that bigger house, and you're getting married, and you need more space. A full-featured mortgage will allow you to move the mortgage over from the property that you currently own to the property that you're looking to purchase. Make sure that the mortgage that you're looking at has that feature.
So when we're first talking up front and I'm telling you about what it is I'm looking to do I need to tell you that I'm looking for a full-featured mortgage? Would you ask? Do you make the assumption? And I'm talking about, I mean, you personally and the industry at large, right? So what would you sort of recommend for first-time home buyers who are interacting with mortgage brokers?
Limor, the way that I work is I don't believe in those restricted products, so I don't even discuss them with my clients most of the time.
None of that, like, no-frill stuff?
Yeah, I wouldn't put myself into that kind of mortgage, so I wouldn't advise it for any of my clients. Unless somebody said to me, I simply want the best interest rate on the market, but I do not advise them. I never have and I never will.
Okay.
You need flexibility when you're borrowing hundreds of thousands of dollars.
Yeah. Now, one of the things that I really wanted to get your perspective on is because you are a mortgage broker, mortgage agent, there's mortgage specialist, there's so many of those terms out there. Can you maybe shed some light on them and why maybe more generally it could be advantageous to work with a mortgage broker versus going into like one specific bank and talking to, you know, not the teller, but like your contact at the bank?
So a mortgage specialist is employed by the bank. They're employed by the big green bank. Let's just use for example.
Okay.
They can only sell you big green bank products. By going to a mortgage broker or a mortgage agent, you're able to access the big green bank, the big blue bank, the other big blue bank, and 50 other lenders across Canada. That is the largest advantage to working with a mortgage agent or a mortgage broker like myself. We can get you the best product on the market at all times, and our allegiance is to you, the borrower, my client, the broker's client.
Okay, then I hope you won't mind my saying
Sure.
that I always advocate working with an independent mortgage broker or mortgage agent versus going into the bank itself. Because A, like you've got my best interest at heart and you can shop around for me on my behalf, right?
And another large thing is, what if you were to buy a property today, and you don't close for 3 months? What if rates fall in 30 days and you've locked into a mortgage rate with a mortgage specialist at a bank. Well,
They
that
may
doesn't
or
happen
may
with
not.
me. That doesn't happen with me because if rates fall 30 days after you've bought, before you've closed.
Sorry, say that again.
Okay.
If rates fall.
If rates fall
Yeah.
30 days after you've purchased, but before you close.
So what do you mean by bought then? Like if I've got a firm purchase and sale agreement?
Yeah, so if
But
you
before I
purchased a
close.
property,
Okay.
if you purchased a property and you don't close for 3 months, which is very
Got
common.
it. So I just wanted to be clear if
Sure.
purchase meant close or purchase meant sign an agreement.
Sign an agreement.
Okay, so if we sign an agreement, we're going to close in 30 days.
Correct.
Sorry, 3 months in your example. Okay, I'm with you.
Okay?
Okay.
So you don't close for 3 months.
Yeah.
You've gone, initially, you've got your mortgage approved, you've got your mortgage contract, it's all done. And let's say, for example, a month after you've signed that mortgage approval, interest rates go down or another bank comes out with a better interest rate. At all times with a mortgage agent, you're going to get the benefit of the two rates. Because at the click of a button, I can either match the better rate that the new bank has come out with, or cancel the old one and submit your application to the new bank at a lower interest rate. So you're always guaranteeing yourself the best interest rate on the market by working with an agent because, again, we work for you. We don't work for the bank.
And so one other element that I believe is better with a mortgage broker agent is if I go to you, you're going to pull my credit once and then you're going to shop it around, right? Whereas or you're going to pull the credit every time you provide it to a new bank.
So I pull credit one time.
Okay.
There are times where the banks may pull their own credit bureau.
Okay. But it can be, so here's what I know for sure. If I'm going to go and I'm going to go to the green bank and then a blue bank and then a purple bank, they're going to pull my credit 100% each time.
Yes.
So if I work with you, there's a better chance that I may actually preserve my credit throughout the process.
Correct, because I only pull the credit one time and I send that credit bureau out to the lenders that I'm looking to submit the application to.
Right, okay. So there is a credit advantageous there.
Correct.
That element is there
Yes.
as well. Okay, so you're working on my behalf. How do you get paid?
Best part of the puzzle.
Okay. I hope you say it's not me.
No. We are compensated by the lenders directly. There's no extra cost to you to use my services.
Okay, so you're going to shop around on my behalf. You're going to get me the best mortgage. If rates go down, you're going to help me out. And somebody else is going to pay you.
Exactly. Free of charge to you.
I love it. So why do you think more people don't work with brokers? Like, is it just that, oh, I know somebody at the bank, so I'm going to go there?
So I find that most people enjoy walking into their branch that they've had a relationship with since they've had a bank account with that bank for the last 15, 20 years. Though, an increasing amount of buyers are now using mortgage brokers. So if I'm not mistaken, the last time I checked, it was about 40% of homeowners and shoppers are using mortgage brokers to get their mortgage down.
Let's get that to like 80.
We hope that day comes very soon.
Well, we're doing our part here because it's definitely, in my opinion, so much more beneficial for the end buyer. But exactly like you say, like, you know, if you've gone into the bank so many times, you know them, you know, and you're thinking of buying a house, and like especially like a financial planner is going to ask you, are you thinking of buying a house? Oh, let me introduce you to Tommy, who's in the office next door. You know, that warm handshake makes a big difference. But I think in terms of what it can actually do, and the kind of service you can provide, it makes a really big difference.
Absolutely.
Okay, I want to jump back just to the end of the process because we kind of got into the process and then I backtracked this. This is a bit of a choose your own adventure here today. So let's say I've got an offer and it's accepted. I've got a financing clause. What would need to happen? I mean, we're going to talk about the property itself. We've maybe gone through an appraisal. You've approved the property and you've approved me. What else then happens with regards to making the mortgage all come together?
So I will work with you. I will work with the buyers to ensure that I'm getting all the right documents. So what are those documents that I would need?
Yeah.
I would need employment verification. So that may be an employment letter and a pay stub.
So you might have gotten that stuff like 3 or 4 months before,
I may have,
right?
but you're likely going to need updated documents.
Updated, okay.
So I'm going to ask you for an employment letter and a pay stub dated within 30 to 60 days. I'm going to ask you for those bank statements to make sure that you've got the down payment ready to go. If there's a gift, I'm going to ask you for the gift to be deposited into your account.
Do you need a letter with the gift?
Yes.
Okay.
You need to get a gift letter to confirm that the money going to your account is a true gift.
And do you give a template, or how does that work?
Every bank has their own template, so
Okay.
it really depends on which bank we end up getting the mortgage through.
Okay.
So the bank's going to want to confirm that the deposit going into your account is from an immediate family member.
Right.
So you just got to make sure that you've got the gift lined up before making an offer. Just don't forget that.
Right, because if it's coming from my cousin's cousin on the other side in China and it's got to be translated from another currency, it takes some time. Okay.
In addition to that, you'll need 2 pieces of photo ID, a void check, lawyer's information. That would really sum up all the documents that would be needed.
And then how does the signing work? And I believe there's different versions. To the best of my understanding, you could sign your mortgage documents with your lawyer or with your bank. Some banks like that, or sometimes even with the mortgage broker. Do you ever do that?
So I virtually every time I will sign the documents with the borrower directly.
Okay, so you actually will participate.
Correct, absolutely, at all times, yes.
Okay, perfect.
Just to make sure that everything is very clearly explained and to make sure that you understand exactly what you're signing. It's the most important purchase of your life. So you've got to make sure that you understand everything that you're looking at.
And will that final document essentially say things like, are you paying once a month? Are you paying twice a month? Are you paying bi-weekly? Like, it'll include that kind of information?
Yeah, you're going to be able to customize your mortgage payments to exactly how you want to pay. So if you get paid from your job on a Friday, and you want your mortgage payment to come out every other Friday,
Sweet.
You can customize that to coming out on Friday.
So you can choose like the day of the month, how many times,
Absolutely.
all that kind
Everything
of
is
stuff.
customizable to the way that you like it to be.
Got it. Okay, so when you provide the mortgage documents and you sign everything, I've typically seen that at that point in time there's another document which offers a mortgage insurance.
Mortgage insurance.
Okay, good. Can you explain a little bit about what that is? And I can tell from your face it's not a product you particularly love.
Sure. With every mortgage, you're going to be offered mortgage insurance. Mortgage insurance is not a good product in my opinion because...
Or in mine. Go ahead.
I'm glad we're on the same page.
We totally are.
You're paying large premiums for a little bit of coverage. You'll be much better off getting life insurance. Consult a life insurance agent for more information. You will be much better off going down that road.
So let's just explain why we don't like this thing that we're, particularly. Sure. So part of the challenge that I have is if I have a mortgage, let's use the same mortgage I've had for the last hour, for $485,000, the bank might say, okay, your mortgage premium on that is $75 a month. And I would pay $75 every single month. Now, 20 years down the road where I only have $100,000 left on my mortgage, I'm still paying $75 every single month. So the amount that I'm being covered for decreases over time, but my payment doesn't decrease. So for me, that's one of the main reasons that it doesn't necessarily make sense as a product.
And there's a few more reasons.
There are others. That's one of my big ones. Also, to the best of my knowledge, and every bank is different, in order to be able to actually qualify for that insurance, like, you have to literally be on your deathbed, your arms and legs have fallen off, so of course every policy is different, and at the time that you're watching this or you talk to your bank, there may be some adjustments and there could be some better coverage, but from the ones that I've seen and from what you've seen, I take it, in order to actually redeem that mortgage, things have to be like pretty dire.
Yeah, to redeem that insurance.
Yeah. So insurance, yes.
Yeah. It's and another big part of the puzzle is the insurance company will underwrite your claim at that time. They don't underwrite you today. So again, it's an expensive product.
Yeah. There's better ways to get coverage.
Much better ways for insurance.
Yeah. So one more thing I'm going to ask you about the mortgage is it ever, to the best of your knowledge, mandatory that your property tax is rolled into the payment of your mortgage, or is that something that you have an option with?
You have the option. Some banks require that they collect the property taxes with your mortgage payment, and then they will pay the city directly.
Right.
Though most lenders will give you the option as to whether you'd like to include your property tax payments with your mortgage, or pay it on your own.
Right, okay. Because I mean, I'm a huge fan of paying it on your own, because then it's the exact right dollar amount and the banks aren't holding a little bit of extra money for you. But I have seen recently that there are some lenders, especially if you're putting down 5% or 8%, or you're not getting anywhere near the 20, where they mandate that is the fact. So I just wanted to get your
Yeah, not in all cases, but in most cases.
Yeah.
Yes.
Okay, perfect. So just as we wrap this up, is there any other tips or tricks or mistakes that you continually see people making that you think could be beneficial to cover?
Don't forget about closing costs. Closing costs are always the biggest surprise that I find first-time buyers run into. Just because you have the down payment doesn't mean it ends there. You need a few extra dollars to make sure that you can pay the lawyer, pay the land transfer tax, pay any moving costs, pay any hydro hookup costs. There's a lot of other costs that go into getting into the property. So just make sure that you're budgeting correctly and that you always save for a rainy day. You must always have a rainy day fund, especially when you have a house.
Yeah, that's fantastic. Well, thank you so much.
It's been a pleasure.
And you are available to help first-time home buyers with mortgages in what area? Are you confined to Toronto or Ontario, or what's your scope?
I'm actually confined to Canada.
Canada, so there you have it. And I'm assuming you're good on Skype and Zoom and all those digital ways.
I am available via all different types of media, phone, email, all types of social media, all types of Skype, absolutely.
There we go. So no matter where you are in Canada, if you're looking to get your first mortgage, Michael has got some great options for you. So we'll link him up, his information below. Thanks so much for being here. Appreciate it.
Pleasure.